Hey, what's going on? Welcome back. Benjamin Yeager with Groundswell Assets. I want to talk to you about something revolving around some conversations I've been having with folks and some very important things to keep in mind. I've been talking to a couple of my friends who are investors, and we've been talking about kind of just, the red flags around investing. Something came up, they said they were, when they first started out investing, their biggest fear or question was like, so what if I give somebody my money? I worked hard for it, and I don't have control, and I'm going into this real estate deal, and I'm handing it over to somebody that I don't know. What happens if they lose it all? How can I be sure that I'm not going to lose all my money? So, revolving around that, I want to talk about red flags of real estate investing, especially when it comes to syndication specifically. So, when you're evaluating a deal, evaluating sponsors, there's very big red flags. These are pretty much like the investing basics, but these are things that you need to be asking yourself, asking your sponsors, and you want to look at deals and try to make the deal not work. And you want to look for every single possible reason why not to invest. And if you can't find any, and the deal looks good after you've run it through the stress test of everything, then real estate syndications, multifamily, it's the most resilient asset class across the real estate completely. So we'll start off. I want to talk about, most importantly, the sponsor. So you're looking at all these deals, the syndication space, there's all these different sponsors out there. It's very important, you know these people and you like them, because getting into a real estate syndication, it's not a big liquidity thing. So more or less you're getting married to these people for, several years. So you had better like them and enjoy talking to them, because, they're going to be giving you reporting, hopefully. So when you're looking at a sponsor, it's really important to look at their track record. So maybe somebody might be newer in the space. If they don't have anybody on their team that has a consistent and successful track record in investing in multifamily, that's going to be your sign right there. Maybe this is not the right person for me. You don't want somebody that's new at this to be using your capital to as a training exercise in investing in multifamily. So look at the sponsorship team. Have they done has any of their deals gone full cycle? Have they made exits? How many times have they invested in a deal and completed and executed on their business plan, right? So really important when you're looking at folks, evaluate the whole team. When I started out, right, what did I do to compensate for this? Well, I got hitched to and paired myself with very successful real estate sponsors. They had gone full cycle on deals. They had performed countless successful completions of syndications where they performed positively for their investors. So if somebody is new, make sure that that you're investing with, you like this person, they've got a great deal, but maybe they're newer at it. Well, who else are the sponsors on there, right? Super important. Let's talk about lack of market experience. So do they have a presence already in that market? Do they have other deals there? Well, if not, maybe they can speak to how long they've been working on getting a deal there. It's something, knowing the local market, having visited all deals there, having spent countless, amount of hours networking with, contractors, vendors, property management companies, absolutely knowing everybody that it takes to execute on a deal in that market is crucial. Somebody that just going in and getting a deal, on LoopNet or Crexy or something like that, and they're saying, "Oh, this deal looks good," but they haven't spent the time traveling to the market, getting to know the neighborhoods. That's a big red flag. We look at deals in markets and we go travel to the markets. We get to know the other operators in the markets. We get to know the construction teams in the markets. Something, if somebody has, putting all their eggs in one basket with, the first people they've called or found out for, like, contractors, something like that. We like to have 3-4 contractors that are very successful, as backup plans. And, it's important to have this network in that market that you can leverage, because maybe what happens, ask the question, what happens if your contractor gets sick or something like that, right? Who's your backup guy to make sure that those units get turned on time so that you can be placing new tenants in there and, making sure that the deal cash flows, right? So really important that having experience in that market, having a network in the market. So another thing, right, is going to be the lack of product knowledge. And what I mean by that is, is somebody going for their first time into that specific asset class? So maybe if they've only invested in, and maybe they've been wildly successful in industrial projects, right? But now they want to build a hotel or buy a hotel and operate a hotel. Well, you're probably not going to want to go along with them for that ride on their first one. So making sure that, sticking to what they do and what they know is their bread and butter. For us, we are strictly multifamily apartments. Our target markets are with 80 units and up, because we know that having on-site management is crucial. So we have a very specific investment criteria that we like to look at when we're finding these deals. Another thing you want to look at is lack of strategy experience, right? So if somebody is going into a ground up development and they've only ever bought pre-existing units, you might be in for a couple of bumps on the road there. So very important that their strategy is consistent with their experience there. And lack of skin in the game from the sponsor, right? So how much have they vested into this industry? How much are the principal of the company? How much do they stand to lose if the deal fails, right? So you want somebody that's all in. If they were to mess up on a deal, what type of company have they built, and how many people are relying on that? And you don't want to be with somebody who's just fly by night. Having skin in the game means they are completely all in, and also as well investing in the deal, right? So when we are looking at purchasing a deal, well, we've got investor equity and we've got our sponsorship equity. We're the ones putting up all of the at-risk capital to get the deal prepared, and as well, we invest right alongside of our investors in the deal, committing a significant amount of equity from our team. That's really important, because you don't want somebody that's just coming in there and using, counting on the money from others to hope that the deal works, And that goes, as well. Sometimes what we like to do is we like to ask our property management company to put a little skin in the game too, because that way, everybody is counting on everybody to succeed who's involved in the deal, because that way, if one, but nobody's going to lose their money if everyone has a little bit in there and are counting on themselves to perform. So really important, make sure that you're not the only one that stands to lose in case the deal goes south. So We also want to talk about who is the debt guarantor on the deal, um, making sure that the person, every deal has what's called a KP. It's a key principle, and that person, is to have the net worth and liquidity equal to or greater than the value of the deal, and usually a track record that is, quite expansive, having executed on similar deals. That way you can be getting the best loan terms, and you know that no matter what, there is somebody on that team that is absolutely behind the scenes pulling strings and making sure that that deal goes through and is a great success. And you want to make sure that you're not looking at kind of just solopreneur kind of people. If it's just one person, like if there's just like a key person that's running the show, like that's a big risk right there. You want to make sure that they have a team of qualified and experienced operators that have executed time and time again. And then lastly, we want to talk about poor investor reporting, right? So at Groundswell Assets, we do monthly reporting. We're very active in producing content around what we're doing there. And we believe, it's part of one of our core values of our company is actually communication. We believe internally amongst ourselves and externally to our investment partners that communication is something that is so crucial, especially when working with someone new. It's really, really good to ask, like, hey, could you show me, like, what does some of your reporting look like? Every month we push out, for instance, for our deal, an investor report. Whether the numbers are good, whether the numbers are bad, we want to be sharing with our investment partners every step of the way what's going on, what we're doing well, what we might need to change up, and just letting everybody know, how the deal's going. You don't want to be sitting there 2-3 months on and, wonder what's going on over there, right? Like quarterly reporting, things like that. It's just not prudent. So, being a good steward of capital is also being a great communicator. So making sure that those reporting pieces are in place before you commit to the deal are very important. It doesn't hurt to ask for examples at any time. And if somebody, they're upstanding, good sponsor, they'll be more than happy to share some of those reports with you, for sure. So besides the sponsor, you want to be looking at their underwriting, yeah? So if somebody doesn't want to share their underwriting with you, just run for the hills straight away. We're very transparent, and we want everybody to feel very comfortable with that. So some of the underwriting red flags are, if the sponsor is showing a very large increase in year one in rent projections, that is the opposite of conservative. So looking at how they are measuring their rent growth is a very big key indicator of whether you want to be involved in this deal or not. So right now, pretty much with the way the market is, we are estimating for 0% rent growth in year one. We don't really measure any rent growth into the property until around year 2 to 3. We start blending it into a 1% up to a 2%, coming into a 3% towards the end of the deal, which is, a lot of times you do a lot better than that. But we like to make the numbers, gradual on the increase rather than right away. Next, you want to be looking for improper economic vacancy assumptions. So that meaning, are they saying like, hey, all these units are going to be full all the time? There's no loss to lease. It's not realistic, because there are times when you're turning a unit, right? Like that unit is down, and then you've got a time to lease up to new residents. You need to be looking for them to at least be factoring in there. When we go to underwrite the deal initially, we just blanket it straight across, like, hey, we're going to have 10% economic, and then, If the deal is more vacant, then we start increasing that. But if the deal is stabilized, meaning 90% more occupied or for 90 days or more, and in a very well performing market, we still put those assumptions of the vacancy. We want to stress test the deal up higher. Additionally, we'll stress test the deal all the way down. Like, hey, can we still cash flow? Can we still make our preferred returns to our investment partners if the deal is down at like 75% occupied? Well, what if the occupancy goes down to 65%, 60%? Does it still work? We try to break this deal in every way possible. If we can't break the deal, then we know we're going to put an offer in and go for it. So you also want to be looking for underestimating the expense assumptions. So a lot of times if you're looking at the underwriting, it says, hey, we're going to bring in and we're going to do our management efficiencies and we're going to get the expenses down to 30%. Well, maybe on a brand new deal, you won't have that much on the expense side because the deal's newer. You don't have a lot of deferred maintenance. But if you're getting in, pre-90s, anything like that, pre-2000s, pre-90s, you're going to be looking at some serious expenses. There might be aluminum wiring that needs to be changed out, roofs. There could be foundation issues. There could be plumbing issues, which on a lot of these older C-class deals, 60s vintage or before, there's cast iron pipes. These things break. Roots get into it. Rust is a real thing. Oxidation, and it can cause big issues that could actually really damage the finances in the deal if those aren't accounted for, or your due diligence is lacking on the front end to measure that you could possibly have some of these expenses coming in down the road. We like to mitigate that by scoping pipes and basically doing an x-ray of the buildings, mechanicals and all the interior things that you don't see behind the walls before we actually get in there and do takeover. So having, we start out with 50% at the lowest number. This depends on the deal, but don't think that anyone is ever going to get to these lower expenses just by their amazingness. You can't smile at the deal and make the expenses go down. Let's talk about taxes, right? So if someone is underwriting the deal with the same tax rate that is already there for the prior ownership, that is a huge red flag. I mean, if one thing we like to do, we like to call the tax assessment office and actually speak to them and say, hey, when we pick this deal up, where is it going to jump? And during our hold period, are there going to be any more reassessments where that deal goes into a higher tax bracket? So really important, that's something that could be potentially, really detrimental to the returns on a deal, is if those taxes go into a different assessment during the lifetime of the deal. Every city's different, and the sponsor really needs to know their market. Again, knowing your market, having experience in your market is going to help you there. And those relationships with the tax office, you got to have somebody down there at the tax office that you can speed dial when you're underwriting deals, and get those proper millage rates. Well, here's one that everyone likes to talk about and maybe not completely understands, but that's cap rates. Seems to be quite a hot topic. Cap rates, right? So the going in cap rate versus the exit cap rate, it's a really important number. You don't want to be assuming a lower exit cap rate than going in. We estimate that there'll be 10 basis points climb every single year. We estimate leaving the deal in a worse financial environment than when we go in. That's not always the case, and especially during market cycles, some people it's basically like winning the lottery. The cap rates compress so hard, and then it goes into a seller's market, and over the last several years, that's been the case. There people have been able to you can't lose in the markets we've seen in the last couple years. But in difficult water, in troubled waters of the economic climate that we're in today, it's really important that those exit cap rates are in line with the assumptions that they're going to be higher than going in. Well, lastly, I want to talk about rent comps, right? So when you're looking at an investment package from a sponsor, check out the rent comps. Are they realistic? Are they close by the deal? Are they in the same neighborhood? Are they the same class? You can't comp a B class property with a C class property or an A class property. Make sure that the vintage is similar, the square footage of the units is similar, the upgrades and amenities of the property are similar, the distance to the market drivers being like the employment in the area and the shopping in the area are very similar. You can't have a C-class deal in a really terrible part of town with a terrible resident demographic and say that you're going to get the same rents as maybe a similar type of deal but on a better side of town. So make sure that your comps are in the right distance. Just something to be very skeptical about is definitely on those rent comps, because you are looking at the sponsor's assumptions of where they're saying they can go after renovation. So that after renovated value is 100% a big red flag if it's not realistic. All right, well, let's talk about the investment package, right? So you get this hopefully shiny, pretty, investor offering memorandum. We like to call it the OM. So when you get this, how is this thing constructed? This is a professional business. You need to be, professional excellence is one of our core values of our team, and that goes all the way from how we conduct ourselves with our other colleagues in the industry down to the actual materials, the aesthetics. It's a very big thing. Like if you pick something up and it doesn't look good, there hasn't been a lot of thoughtfulness put into it, then you can kind of assume that there's not going to be very much thoughtfulness into the deal, right? So it's like somebody who is maybe like they say that their expertise is in detailing, right? But you look at them pull up and their car is like covered in mud. And dirty inside, how can you expect them to look after your car if they're not even looking after their own? So good looking at offering documents, big red flag if something's off there just the way it looks. When it comes to these, you can judge a book by its cover. A lot of thought needs to be going into every single aspect of the deal. So when you get this thing open, you're going through the pages. One of the most important pages that you want to be looking at is the sources and uses, right? This is where you can pull your calculator out and check their math. You want to make sure that there is nothing missing, the sources and the uses. You want to make sure it all adds up exactly. If it doesn't, I've seen this before. You definitely want to be asking some questions there. Where are those funds ending up? Everything needs to be accounted for. Where are they spending the money? On what are they spending it? We put in on our recent one, we did a detailed breakdown of which units are getting what upgrades. We've got granite, brushed nickel, fixtures, stainless appliances. Even down to the kind of paint we're using. It's all calculated out. There's no guesswork in investing in multifamily. This is a strategic business plan to get out our desired predictable outcomes, right? So we try to make everything about the process as predictable as possible. When you're looking at these funds and these sources and uses, right, you want to be asking, okay, how much capital are you raising in reserves? So, short of acts of God, things anything and everything has happened on these deals, and depending on the vintage, this is where also sponsor experience comes in back into play, right? How many times have they done this? Who is on the team that's done this before? That's how they're going to know how to be raising an adequate reserves, because I was looking at some deals this weekend, and I drove into the market talking with the sponsor, and they're very lucky. These deals we're looking at right now, they raised enough, but they could have absolutely lost everything. They had unpredicted pipe ruptures from, not because it was old, it was because they had pipes installed in the building that were under a manufacturer's warranty. That, how could they have ever known that? So I mean, short of knowing what who the manufacturer of the actual water plumbing for the building was, which is something I'm going to ask in the future now and find that out. But the pipes burst and water went in the building. They had to get residents moved out of there, and it put a number of units down, which resulted in a loss of cash flow and a huge capital expenditure to replace all the plumbing. So you want to see that there are adequate reserves being built in to the capital raise, or for the lending requirements, because say what if, what if, try to kill the deal, try to ask as many what ifs and ask them to the sponsor, and if those objections can be overcome, if those questions can be spoken for with somewhat of an intelligent answer, then you're dealing with a sophisticated operator that has executed and knows what they're doing. So when you're looking at these deals, you want to be looking at the debt they're using on this, making sure that they're using the right amount of debt. You don't want to see somebody be completely over leveraged, going in, getting, say 80% of the purchase price covered by debt. Well, that's a lot of leverage. One of the biggest things you want to see is just don't be over leveraged. Recently we did a deal, and I believe we used about 64% leverage on that one, and we did, sponsors committed a lot of equity, the property management team committed equity, and we raised the rest from our investment partners. But it's a big deal. You don't want to be over leveraged, and just if you can take anything away from this and you're looking at these things, remember, run if they're over leveraged. Don't be over leveraged. You want to be making sure as well that these sponsors that you're evaluating, they understand the terms that they're using, and they are clearly illustrated in the sponsorship investment package. The internal rate of return, the average annual return, the cash on cash. How are those being modeled out? A good way to do that is, how we like to do, we'll actually put a table in there. So it gives a standard definition, basically. Like if you invest $100,000, this is what your returns look like all along, and that's how these return metrics are calculated out. So making sure that they actually understand those and they're not misrepresented, can be a red flag for sure, because I can tell you, there's some inexperience there, or just some carelessness that they didn't bother to be detailed enough to spell that out for you. Next up, when you're looking at the package, you want to look for a lack of waterfall calculations. So, meaning as the cash flow comes into the property and it goes down, trickling down from the debt to the preferred return on whichever class of investor you are in the capital stack, you want to make sure that those are all modeled correctly and demonstrated. So from when the money comes into the property to when it goes out to distributions, check on the waterfall, make sure that it lines up and it's actual and it's relevant to the underwriting for the property. Next, you want to be looking at the sponsor fees, right? So how are the sponsors of the deal getting compensated? Sometimes I see I've seen all the way up to 5% acquisition fee. Looking at things that seem just a little bit off, or a little bit like, or in the favor of the sponsor, and not in the best interest of the investment partners. Making, you want to make sure that they're not trying to just, put all of the fees on the front end and there's no reward for performing on the deal. We like to have, because it does take a lot of effort and, energy to bring these deals out to our investment partners. We invest a lot of time, talent, and our treasure into these deals, preparing them. So, there is a certain amount, between 1 to 3%, depending on what you need to make the deal work. That's a good range, between the 1 to 3%. You want to be looking for your sponsors to be compensated that much on the front end for bringing out an amazing investment opportunity. But during the life of the deal, are they getting an asset management fee? How much is that? 2% is probably common. You're gonna look for that. If they're paying themselves 10% asset management fee, they're either it's like the best deal that ever existed and there's more cash flow than there's ever been on a deal ever, or something is awry. So making sure that the sponsorship compensation package there is not too exuberant. Also, capital transactions. So a lot of sponsors like to charge capital transactions. So if they didn't refinance the deal, they'll throw another couple of points in there. And then a disposition fee for actually selling the deal. These are things to take into consideration when you're looking at the deals. If that's something that you're willing to, pay them, good for you. But like every deal is different, and you need to take into correct measure. I would take and compare to other deals, right? What are these ones charging? If it aligns with other deals you're looking at, but you like that deal, go ahead and invest in that deal. If it's conservative, right? Being conservative on all fronts, the underwriting, the sponsorship compensation, and how the vast experience of the operators in the deal is very important. Furthermore, you want to be checking out that business plan, right? What are these guys going to do with this property? Is it realistic? Are they counting on, the cash flow coming from other income? If they don't add 100 vending machines to the deal, does it still work? You want to be very conservative on those outcomes. So making sure their business plan is, gradual, aligned with the market, steady as she goes, making sure that it's realistic, it's just such an important thing. So a lot of this stuff, it's a no-brainer, right? It's very straightforward, but we want to be putting out these items for you to consider as red flags when looking at these deals, to help you make sound investment decisions and have a great success on your next deal. So until next time, I hope you guys enjoyed getting to know a little bit more about some of the red flags to look out for when you're investing in apartments, and we'll see you next time.